over the long-term ownership of a real estate portfolio, the three big variables that can really chew into your cash flow and your seed capital are your vacancy costs, your repairs and maintenance costs, and your management costs. When we look at any pro forma, these are the three big variables that have a big question mark over them all the time.
Hey guys, Russel Westcott here. So in this clip that was taken from a long form podcast, I had an opportunity of sitting down with my business partner, Jason Mattern, who's just a wealth of information. So in this one, we went in depth into talking about cash flow killers, the big three, as we call it, the three biggest unknowns, the three biggest variables that will sink your cash flow on a long-term performance of a rental property. So if you're interested in increasing your cash flow, reducing your risk, reducing some of your expenses, and having a better ownership experience, pay attention. This video will reveal all. Let's get after it. One more piece of content that I want to share and want you to teach here is when you own a piece of real estate, you call it the three biggest variables, the three biggest costs of owning a piece of real estate. Share with everybody what those three biggest costs are and how can we as rental housing providers start softening those costs, lowering those costs, and having a better ownership experience.
Okay, great question. You're hitting me off the cuff with these today. So, it kind of, I'll circle back to where, the term pro forma shopping again, and it's not what you can see, maybe what you can't see. And over the long-term ownership of a real estate portfolio, the three big variables that can really chew into your cash flow and your seed capital are your vacancy costs, your repairs and maintenance costs, and your management costs. When we look at any pro forma, these are the three big variables that have a big question mark over them all the time. Our mortgage rates are typically fixed. Our insurance is typically fixed. Those are easy. They come in renewable terms. But the vacancy, the repairs and maintenance, and again the management costs are something that can run out of control if not tended to up front. Now the good news is at time of purchase is when we can really have a look and mitigate, if not outright eliminate, a lot of the associated variables that will affect those big three, and just really repairs and maintenance, for example. We're looking at new construction product for the most part, or fully renovated product that is not going to need a roof, or it's not going to need a furnace, so basic, and it's under warranty. For the first 10, 15 years of you owning this thing, if you're going to own it that long, there should be almost zero repairs and maintenance at a high level. There's going to be some tenant turnover stuff we're going to have to tend to, but the big ticket items are going to be tended to. They're under warranty. They're taken care of. The vacancy kind of circles back to, I guess, the three pillars of just really, understanding what our customer wants, Russ, and finding it and building it for them. And, by doing that, we just inherently reduce our vacancy costs because, when we bring it to market, it's exactly what this tenant profile wants. We can easily rent it. And then when there's a turnover, we know exactly who we're renting it to and getting it back, at full occupancy. Of course, the management cost with that, we need to understand, I guess, and, hats off to all the property managers out there because they really, do a bang up job. But at the end of the day, it's a business. So every time a property manager, turns a wheel, effectively, it's going to cost you money. They charge, typically a percentage of the rental income. But if there is repairs that they have to tend to, and manage, it's time. Of course, you have to pay them for it, rightly so. And same with tenant turnover. Every time a tenant leaves, Russ, it costs us money. So just for example, I'm going to throw it out there. I'm going to say it's going to cost us $2,000 at least for any suite turnover, because we're going to have to go in, we're going to have to tidy it up. We might have to paint some things. We might have to repair it. We're going to have to remarket it. We're going to have to re-screen tenants. We're going to have to re-show it, and worst of all, you might have to sit on a vacant suite for a month or two. So if we're making a property and buying the wrong property, but let's just say this property on the pro forma makes $500 a month cash flow. Okay, great. That's $6,000 a year. But if you have two tenant turnovers and one suite up and one suite down, and that could cost you $4,000. Well, at the end of the year, your $6,000 cash flow is now only $2,000. Plus, you had all the headache of dealing with that and the time of dealing with that. Now, where that really, I guess, can affect long-term viability in our financial statements, Russ, you and I have often said we can pay for a property inside 15 years. And I still believe that today. I'm a living, breathing example of that. However, in order to utilize that strategy, you need to take your cumulative cash flow that we make on a monthly, yearly basis, and we need to put that down towards mortgage principal reduction. So if we're taking our $6,000 that we can lump down on our mortgage, but we've just, had to incur 2 tenant turnovers that cost us $4,000, and say some repairs and maintenance that cost us another $1,000, you got $1,000 left over. So it's not to me, it's not a great long-term strategy. But again, the good news is, you know what? I am going to have a look at that stuff right now, and we're going to pause, and we're going to, when you're coming to purchase something, this is the stuff we're going to look at the pro forma at step number 1, and then we're going to look at all this other stuff we can't see. Stuff that would cause a tenant to leave, like maybe a shared laundry, or maybe no parking, or maybe there's no good soundproofing, maybe there's not a separate entrance. We just want to make sure everything is in line for when our tenant comes. They're going to have a beautiful stay, they're going to enjoy it, and most importantly, they're going to continue paying us rent.
Yeah.
That's going to reflect on our financial statements.
Yeah, and that's one of the things, and I know you do this because I'm a client of yours, and I see you doing this with clients all the time. You literally, when you're going and selecting a property for a person, you go there and you put yourself in the tenant's shoes. This tenant here, look, if what you need to do is, we got this corner lot, perfect. That's what we want, because you got all this parking on the side, you got 3 pads in the back, you got all this parking in the front. But here's what's going to happen. The door out the side, the tenant's going to walk across the lawn over here, and you're going to actually probably have more expenses because the grass is going to die, because this is where the tenant's going to park, closest to the door, going to walk across here. What I would recommend you do is you put a cement pathway here, or you put something here, just to, because you really just truly think about it from the tenant's perspective, and all those things just add up to saving the owner's money. The better tenant experience, the less turnover, the less vacancy, the less maintenance, and the less management issues you will have. That be a case, Jay?
Oh, absolutely. Yeah. And not only the tenant perspective, Russ, it's from an owner perspective too, because, looking at this stuff that I have to deal with, on a monthly, yearly scale, just exactly that, of where the tenants are walking, for example, and where the wear and tear is happening on these properties over the course of a 10-year term of ownership. But you're right. If we can solidify that stuff and take care of that stuff right up front, it's going to make for a more efficient investment. And you know what? Again, I'm going to circle back. If you're not spending money on vacancy, you're not spending money on repairs and maintenance, and you can really reduce your management costs, you're going to be able to chunk cumulative cash flow on your mortgage. Or, take that money as seed capital and invest further if you're still in acquisition mode. But at the end of the day, that money is best utilized in other avenues like mortgage principal reduction or further acquisitions. Investors, yep. Russ, we're talking about financial statements, and this is something that's probably very true across the board. Is I don't know of too many investors that count extra capital that they put into their investment after the fact into their long-term ROI. So, for example, if you have to put a furnace in it and you don't have enough cash flow, so you got to take $5,000 out of your own bank account to put in there. Well, that $5,000 that you just put in there actually inherently just reduced your ROI long-term, but no one ever counts that. Right? You should be able to buy, and again, I'm a living, breathing example of this. You should be able to put 20% down, and you should be able to walk away from that property. It should supply you cash flow and support itself from day one moving forward. You should never have to put money into that investment further. And we can do this right, but we just need to, like I say, get our eyes off the pro formas and saying yes at pro forma stage. That's step number 1. Okay, let's look at the pro forma. And then now we kind of need to take that next step and tie it together in a nice big red ribbon, right?
Hey, I sure hope you enjoyed this video. If you are interested in moving forward with velocity, if you're interested in being a successful real estate investor, only 2 simple next steps from here. Number 1, below where you're watching this, there will be an opportunity for you to subscribe. And over here will be a hand-selected video for you to keep moving forward. Continue your journey forward. Just click on over here, for that hand-selected video for you, and we'll see you on the other side. Thank you very much.